Okay, we're going to get started today by looking at the S&P 500. You can see that we're overbought, and we've been overbought for at least 2 or 3 weeks. We're at the top end of our trading range. You can see we're at the top end right now of our channel, and we're approaching one of the worst seasonality times of the year. I have these yellow for a reason because they are some of the worst months. You can see if our average monthly stock market returns for August, September are usually negative. So we are overextended right now in the stock market, and we're approaching one of the it's a options expiration day in a couple of days, and on Friday. So usually there's a lot of activity that day, up and down. So you got to be ready for volatility. So we are overextended, we're overbought, and usually that's an indication the stock market's going to go down. So you have to be ready for that. Let's look at the front page of the Yahoo Finance. Yahoo Finance is one of the best places to go for news on the stock market and stocks. Okay, so here's the story. Five-star analyst sets alarming SpaceX stock price target. Okay, right now SpaceX isn't profitable, so that's pretty speculative. Um, we'll go over SpaceX a little bit later on to see when it's going to be profitable. Look at this. Meta to face massive social media addiction trial today. Okay, so we have we talked about Meta for quite a while. It's one of the Mag 7 stocks. If we look at Meta's chart, there it is right there. You can see we're in a downtrend. We're right in the middle of our channels. So, and we're overbought. So basically what's happening is we're zigzagging down in this chart. We're going to go up and then we're going to go down. And until we break out of that range, we're going to keep going down. So it's very dangerous right now to buy Meta. We see some very smart people buying Meta. So we're going to review today in our meeting um, what some of the smartest people in the hedge fund and mutual fund communities are doing. This is one of my favorite times of the year. Every quarter, the companies that manage over $100 million, such as hedge funds or mutual funds, have to report their top holdings. And this is your glimpse of what some of the smartest minds in the world are doing. So let me see, August 14th is the day that everyone has to have their top holdings in. So we're going to go over some of the smartest people's top holdings and what they did this quarter and see if there's anything in there that we want to research. All right, so let's look at some of the earnings that came out. We had Cisco come out with earnings this past week, Applied Materials, Berkshire Hathaway. There's not a whole lot of market moving numbers coming out. This is kind of the end of earnings season. The only stock that the market cares about that's going to report next are NVIDIA and Micron. They're going to come later on in the month. This week, we don't have, this coming week, we have Home Depot, Target, a lot of retailers this week, Walmart, TJX. So this is a lot of times in the stock market, similar companies report together. The first week of earnings season, we have the banks come out with their earnings. Then we have the large cap tech stocks. Now we have retail. So these stocks don't move the market that much. We have Ross Stores, TJX. We have just a lot of this gives you some ideas of how the consumer is doing. And Walmart's probably the most important one in this. That gives you a clear idea of how people are spending. And a lot of, I'd say 70% of the economy right now is the consumer. So Walmart's going to give us a great idea of um, how the economy is doing. All right, so let's look at some of our numbers here. We were unchanged for the week. We had a lot of volatility, but it's very interesting that we're basically where we were last week at this time. Um, our short range S&P short range oscillator is still overbought at 3.23. We basically have an unchanged 10-year from last week, but we are definitely going up. So we have a lot of danger flashing here. The most important thing here is the interest rates are going up and the price of oil is going up. So let's look at the interest rates and the price of oil. First of all, interest rates. We can't ignore, see, you can see that we're in an uptrend here. And you can see that in the past week, we are going up. And usually there's an inverse correlation. When the interest rates are going up, stocks usually go down. And that didn't happen. So we have almost a coiled spring as the interest rates continue to go up in yield. Here it is again, going up a lot today. As the interest rates go up in yield, stocks usually go down. So expect as the interest rates continue to go up and as oil prices continue to go up, expect the stock market to go down. So we're going into one of the um, one of the worst months seasonality wise in the stock market. And on top of that, we're overbought. So it all points to the stock market going down next. All right. So you can see the price of oil is going up. We have the US dollar is unchanged and the price of gold is going up. But the US dollar index is kind of in an uptrend if you map it out like this. So that's usually not good for multinational stocks because as the US dollar goes up, the amount repatriated for companies that do business overseas. So companies that are large international presence won't do as good. So let's look at fear and greed index. We are more fearful than last week. So our indications are opposite. So whenever people are greedy, we have to be cautious, take some profits off the table, or don't buy. So we have another indicator that we are overbought and to take some profits. We also have the amateur individual investor is bearish. And a contrary of that is time to start looking for something to buy. But the amateur investor has been bearish for like 20% in the stock market so far this year. So, um, okay, so the VIX is super low right now. There isn't a lot of fear in the stock market. So, okay, so there is no fear. So that is indicating that people are in a buying mood. Whenever the VIX gets up to like 20 or 30, that is an indication that it's time to buy. Whenever the VIX is low, it's an indication to sell or don't buy. So let's look at our emotional graph. We have greed in the stock market right now. So whenever people are greedy, it's a time not to buy and it's a time to sell or be patient. Okay, let's look at, okay, this is interesting. The sector valuations relative to history. What are some of the best bargains right now? Okay, energy, financials, utilities, and communication services are all um, the lowest rank compared to history. The most expensive right now are consumer staples, healthcare, and industrials. Okay, but the lowest PE ratios right now are in the energy and financials. So you have less risk in buying those right now. So a lot of times whenever I look at this, I try to avoid the sectors that are higher rank compared to history and try to look for stocks or um, indexes in the sectors that are out of favor. So energy is one of the stocks, is one of the sectors that is the least in favor right now. All right, so let's look at the sectors doing the best and worst this year. The best sector has been energy and information technology, industrials and materials. The worst sectors are consumer discretionary, communication services, and utilities and financials. Okay, let's look at some of the stocks doing going up and down. Okay, so we have um, a lot of AI infrastructure companies going up today and chips for the AI build out. We have SanDisk, we have Micron, we have Western Digital, Light, Lumentum Holdings. These are all stocks that are the AI build out. And okay, and they've all gone up together. Look at the ones going down the most. We have a lot of software stocks. We have Reddit. Reddit actually, um, it was announced recently that they're going to be added to the S&P 500. So they went up 15% that day, and now there's some profit taking on that. But the interesting thing about the S&P 500 addition, um, the S&P 500 committee is pretty smart. They don't add a company to the S&P 500 unless it's had sustainable amount of earnings, quarters with positive earnings, and they're a great company. So it's basically it gets an approval by the S&P 500 group, which is pretty decent. So I'm going to keep track. We're going to keep track of this Reddit. We talked about it a couple weeks ago as a stock that had quality potential. They also have an AI facet to the company, in that companies like Google would train their AI models on their data. So that is a um, it's a valuable commodity to have a um, database full of people's comments. So let's keep an eye on that. It went down 7% today. We have Constellation Brands. Okay, so Apollo Global, um, they lend to small companies, and we have ServiceNow. We have a lot of software as a service in the top decliners. Um, software related companies. So let's look at some of these. Trade Desk, they make software for advertising. We have ServiceNow, of course, they make these software for maintain maintenance of servers over networks in the AI data center and for companies. We have Global Management. They lend money to companies. A lot of their companies they lend money to are software companies. So that was a big top decliner today. Corning is another AI data center build out company. So keep in mind that these are some of the most undervalued companies in the stock market. We've been following these for quite a while, but they can easily go down in half because each of these have gone up a lot this year. We're approaching one of the busiest and but most volatile times of the year in September and August. So don't be surprised if you have a correction in these top performers. So we're going to keep track of, the most undervalued stocks. If we look at our scan for this week, let's look at our scan. You can see SanDisk, they are 0.07 peg ratio. It means they're very undervalued. And we have Seagate as one of the um, top stocks in our screen. And you can see that a lot of those related stocks are going up today. So what we're going to find is as we approach the summer months and August, September, we're going to have a lot of volatility. So the most important thing to do when you're investing is to keep track of the PEG ratio and what the fair value of the stocks that you own are. Because usually stocks in a volatile environment go down to a fair value and they go down to like a moving average. So you have to keep track of the moving averages, fair values, and that'll help you get through some of the volatility. Okay, so let's look at some of the sectors going up and down. We know the interest rates are going up. So let's look at the sectors doing the best. With interest rates going up, biotech, usually companies that need to borrow money would go down, but it's opposite now. Biotech is going up. Biotech companies they borrow money. Um, Semiconductors going up, energy. Let's look at the stocks, the sectors going down the most. Consumer staples, retail, financial, home construction. We expect home construction to go down because as interest rates go up, home building and home purchasing are less affordable. Real estate, that makes sense. And home builders, of course. So this all is related to interest rates. And as the interest rates go up, the demand for sectors that pay dividends, such as healthcare and telecom, go down. All right, that was good exercise. Let's go back to our talking points. Okay, so this week we have yields of the 10-year going up. So that's positive for banks, value stocks, insurers, energy. It's negative for high growth stocks, small cap stocks, high yielding stocks, and home builders. Okay, so it's always good to review this because this happens every day. Let's look at risk on versus risk off. We're approaching one of the most volatile times of the year. Stocks were risk on in general for the most part of this year, but now we're going to a part of the year where we're going to be risk off. You can see that risk off healthcare, consumer staples, energy, defense stocks, these are all going to be the ones that are doing better. So as we approach the next 2 months, keep in mind, um, it might be a great idea to start looking at these types of stocks for your portfolio if you're interested in stocks that do well in this environment. Okay, so let's look at some interesting charts here. You can see the gold chart, chart of gold. You can see there's a huge downtrend. Um, and we just broke out just a little bit of that downtrend. And that could be an indication that the gold trade is starting up again. And a lot of times, whenever we get into the volatile times of the year, like September, October, and August, a lot of times gold goes up when stocks go down. So keep that in mind. Let's look at our stock screen for this week. We see a lot of banks in the top stocks in our list. We have JP Morgan, we have MasterCard, a lot of financials. We have Morgan Stanley, Goldman Sachs, Royal Bank of Canada. So we have a lot of stocks that are financials in our screen. I like Netflix is a very interesting stock. We just saw some of the top holdings of Bill Ackman, and this he just bought Netflix. So whenever whenever some of the greatest investors announce their top holdings for the quarter, usually the stock goes up. And Netflix went up like 5% the day that he announced his position. I like to keep that in the back of my mind. Yeah, it's a good stock. Bill Ackman bought it. And we know that the stocks are going to go down in the next 2 months. So let's keep an eye on Netflix. Right now, its PEG ratio is still a little bit pricey. It's 1.16 PEG ratio. So it's around 16 times overvalued. So not 16% overvalued. So let's keep an eye on that. As a long term, we can buy and hold it. We see GE Veranova is about around 30% off. We have SanDisk 0.07 PEG ratio, which is very undervalued. So as we get into the more volatile times of the year, we're going to keep an eye on some of these stocks that are undervalued. And if you're interested, you can start dollar crossing into them. We have Seagate, which is around fair value there. Capital One. Let's go over Capital One again. It's around a PEG ratio of 1. So that sounds pretty good. And financials are one of the most undervalued sectors. So I always like to look at some of the sectors that are out of favor. Like right now, oil um, that was out of favor last year, and now this is one of the best performing sectors. So let's look at COF, which is Capital One. You can see that along with the other financials, it's starting an uptrend. And that's there was this downtrend. Right here is where it broke out of its downtrend. If you look at that, it's a little bit overbought right now, but it has a very low PE ratio. And they're in an industry, I like the payments industry. They're in a very competitive industry where they have a network. They just bought Discover Card. There are only 3 networks really in America: Visa, MasterCard, and American Express and Discover. So there's 4 major networks, and they own Discover. So let's keep track of this one, because with the volatility, we're gonna see stocks a lot of times go down to their moving averages, which is kind of lower than where they're at now. Capital One, they're growing at 16.8% from this year to next year. So if you have a PE ratio, it's only 11. So the PEG ratio is 0.68, and that's around 30% undervalued. The profit margin is great. Return on equity is barely what we're looking for. Total cash is more than debt. So they have 10 billion net cash, which is great for a bank. And so I think it's a stock that's fairly valued, and whenever the stock tanks, we'll buy some. Right now it's kind of fairly valued. You can see that Morningstar thinks that it's fairly valued. It's priced, the fair value is 0.97. So they're not that excited about it right now. So let me see. Okay. So CFRA says our 3 stars hold opinion reflects that while Capital One has benefits from acquisitions improving revenue diversification, ongoing Middle East conflict, pressuring, giving significant consumer exposure, near-term headwinds will offset benefits for higher income expansion. So they're very affected by consumer delinquencies. People, I mean, right now we have a big problem where there are more delinquencies for the average consumer, and they have a lot of low-end consumers that they lend money to with their credit cards. So American Express is kind of the opposite. They have ritzy, richer clients. So so that's going to affect Capital One right now. So as the stock market goes down, this will not do as well. So we have a hold for CFRA, and Capital One, they have subpar. They don't have 5 stars, they have 3 stars. So in general, the fair value of Capital One and for CFRA is it's overvalued by 4% or 2%. So it's basically fair valued, not something to get excited about. So right now, I'd like to keep this in the back of my mind whenever it drops, like in a big amount for whatever reason. I'd like to look at it as a long-term hold. I bought Visa and MasterCard during big market corrections. Like I bought Visa on its IPO in like 2011, and it's been growing like 11 to 15% a year. And MasterCard I bought during the pandemic, and it's growing at 20% a year. So I'm going to wait for this one to like drop during a major market correction. So let's come back to that one. Now, this is, like I mentioned, the best time of the year for me, during the quarterly reveals of all of the holdings of the major hedge funds. David Tepper is one of the smartest hedge fund managers. He's one of the more successful ones. And whenever he releases his top holdings, I like to look at it because we both think in a GARP growth as at a reasonable price mentality. And a lot of times the ones that he chooses are the ones that I've already bought, and we're like on the same wavelength. So just last week, we were reviewing Taiwan Semiconductor, if you remember. And look, this is the top hold. He increased his position in Taiwan Semiconductor by 24%. So, and of course, we've been looking at Google for quite a while also. And so whenever and we're looking at Micron and all these stocks in his top holdings. So this is like a good verification. If you own a stock, or if you're thinking about buying a stock, some of the best minds in the world are buying the same stock. It's good to have in the back of your mind. And we're going to go through some volatility in the next month or two. So keep an eye on some of these stocks that he's buying, because a lot of times they're going to be half priced in it pretty soon. And it's great. It's great to buy stocks um, that are owned by some of the smartest people. And we also had Berkshire Hathaway increased their Google purchases this quarter. So let's look at some of the stocks that he sold. He sold Alibaba, he sold AMD, he sold out of SanDisk, and he sold a good portion of Micron too. So, all right, that was a good exercise. So we'll go over some of these other ones at another day. On another day, he bought some Baidu. Um, that's a new position. And okay, but the biggest, one of the biggest positions in his whole portfolio is Amazon. That's amazing that he would put a lot of money in a big company like Amazon, but it did go up 15% one day in the last month. Let's look at some of the stocks that he sold out of. He sold out of United Health, SanDisk, Raytheon, PDD, which is a Chinese retailer, Microsoft, Lyft. So, and they sold out of Corning. Let's look at Stanley Druckenmiller. He's one of the smartest hedge fund managers in the world. And look at what he bought and sold. So, so some of the stocks that he bought, Taiwan Semiconductor, look at that again. 19%. We see a lot of AI infrastructure build out companies. Seagate Technologies up 140%. So we're going to see a lot of volatility in all of these names. So what I like to do, I like to keep track of, what the smartest hedge fund managers are buying and selling. And whenever there's a lot of volatility, start looking at dollar cost into those. Okay, so he just bought into Google, Alphabet. He bought a lot of Amazon also. Look at that. That is a 3% position where it was nothing before. And he sold out of SanDisk, very similar to David Tepper's purchases. So for me, this is a lot of fun going through the top holdings, what managers bought and sold. But I like to put this in the back of my mind because right now people are buying and people are excited in the stock market. That's not a time to buy. You want to wait for everyone to be selling and for each of these to be down 10, 20%. And that's the time that you want to start dollar costing into them. Okay. Here's an interesting picture. It's like the game of Jenga with Oracle, JP Morgan, NVIDIA, SpaceX, Microsoft, all relying on OpenAI and Anthropic. So when these companies are making their AI data centers and build out of their cloud infrastructure, their biggest customers are OpenAI and Anthropic. So if there's any problems with OpenAI and Anthropic and their growth rates, they could cancel some of their contracts and this whole Jenga could collapse. And that's why there's so much volatility in this AI infrastructure build out at this time. So very easily, every one of these companies in this Jenga build out could go down 10, 20% if there's a hiccup in some of the growth rates in Anthropic or OpenAI. Just keep that in mind. So that's just a hint that you might not want to put as much of your investments in some of these because it's kind of on shaky ground right now. Okay, so in this ecosystem, there's an article that came out in Wall Street Journal about how all these are related right now. NVIDIA invests in OpenAI to buy their products and then to lease data centers. So this is really, really, it's kind of sketchy right now. In the vendor financing, favorable terms, and NVIDIA is an investor. yet they still get money for them for buying chips. This is very similar to what happened in the year 2000. So it's kind of sketchy right now, and um, it's getting to a point where it could be time to start putting your money into some um, diversifying out of this trade. Okay, so you can see that right now a lot of companies that are hyperscalers are losing money, and they don't have a whole lot of free cash flow, and they actually negative free cash flow with the promise of having a lot of cash flow in a couple of years. And if those two companies, OpenAI and Anthropic, don't come through with all of their demand for these AI data centers, this expected free cash flow is not going to be in existence, and the whole house of cards will go down. So that's what's happening right now with these companies: Meta, Microsoft, Alphabet, Amazon, and Oracle. But for me, I've owned Alphabet since 2007. Um, they're investing right now in what could be a really big payout. Even if this collapses, Alphabet will still survive and they'll still be growing 13% in the next couple of years. Um, they might have a year or two without earnings, such as this, that their stock will go sideways, but they'll survive and they still have a monopoly. And companies such as Meta don't have like as much immediate, they don't have that estimate of free cash flow that Microsoft, Oracle, Amazon, and Alphabet do. So that's why Meta, they're spending a lot of money, but they're not really, there's not a good vision of return on their investments. So that's another reason why Meta is kind of sketchy right now. All right. Um, okay, let's look at some interesting charts. You can see that XLV, this is the healthcare sector, it's in an uptrend. And you can see that it's at the top end of its range right now. So we could have a time maybe in the next month where the healthcare stocks go down to like a bottom end of this trading range. But in general, healthcare stocks are in an uptrend. And you can see that Apple is a very interesting chart. You can see that we're almost at the bottom end of the range, halfway. We're oversold. This is an example of a stock that did not spend a lot of money on that AI data infrastructure, and they're benefiting. They're benefiting from AI because they're leasing Google Gemini from Alphabet. But you can see that they're oversold right now. And as the AI data infrastructure companies might be more volatile in these 2 months, you might see Apple as a company that does better because they don't have a whole lot of debt and spending that the other companies do. This came out in the Wall Street Journal. The commitments of all these AI infrastructure companies are pretty big. So a lot of the big tech stocks are committing to spend a lot of money on this AI data build out. And that is one of the biggest issues that that cause corrections. So that's another reason why some of these big tech stocks could be kind of on sketchy ground. Let's look at another top holdings update for Fidelity Contra Fund. Um, you can see that Contra Fund sold 14%, they have 14% less in Meta. They have in Berkshire Hathaway, they sold 35% of their Berkshire Hathaway. Microsoft, they sold out of 18%, and they bought some Broadcom, they bought ExxonMobil. That's interesting. They usually have tech stocks, but um, they increased their ExxonMobil by 36%. And they they have SpaceX as a top holding now, which is around 3% of their portfolio. Um, and they reduced their GE Veranova by 20%. So I always like to look at Contrafund, and this is very interesting. They still have a 12% position in Meta, even though Meta is in a downtrend, and they're facing a lawsuit against um, they might be causing harm to kids. So that's another reason why Meta is on sketchy ground right now. So let's keep an eye on that. I thought it'd be interesting to go over SpaceX because, as you can see, SpaceX is a 3% holding in Contrafund now. You can see that they're not making money this year. They're losing 2 cents a share. Um, Next year they'll be making 147 and then $4.06 in 2028. So it's like a 300% growth rate there, but you have to put up with this year of not earning money. And you can see they don't even have a PE ratio or a PEG ratio right now. And some of the profit margin numbers aren't even there. So this is really sketchy. They don't have Warren Buffett would not invest in this company because Warren Buffett wants um, companies that have a history of earning and predictable earnings. Um, I guess the good thing is they have more cash than debt right now. But in general, I'm not interested in this because it's just not profitable right now. If you believe in war, there's a lot of people that follow Elon Musk, um, and they'll buy it regardless of profitability. But as you can see with Tesla, Tesla is in a major downtrend right now, and they're overvalued still. Let's look at Tesla. Let's look at Tesla. Look at that. Just like Meta, you can see that they're in a downtrend. They're not growing their sales in their cars anymore, and they're investing for the future for robots. So it's you might be in the similar situation with SpaceX. So it's kind of sketchy right now. Okay, that's what I have for today. I hope you enjoyed that talk and hope you have a good investing week ahead.